Vacancy rates are still climbing in the North's major office markets, and they probably haven't peaked. But landlords, agents and investors seem unfussed. Should they be? I'm David Thame, analysis editor at Place North. In today's Place podcast, we'll look at puzzling data in the northern office sector. We'll also ask what Donald Trump's push to devalue the dollar will mean for northern cities, and watch Angela Rayner getting busy on data centres. The volume of empty but on the market office floor space in the North's major cities has been growing for the last 4 years. The trend shows no sign of slowing. CoStar mined the data for this podcast and reports that Manchester's vacancy rate has climbed steadily, more or less month by month, from the first quarter of 2020, where it was about 5.1%, to today's 9.5%. In Leeds, the same journey is a steady climb from 4.1% to 7.2%, and in Newcastle, 6.7% to 8.9%. Liverpool and Sheffield went exactly the same way and landed at 7.2% and 8.1%. This is all bad. The best you can say is that the rate of growth is slowing, but that's about it. This podcast has been told the vacancy rate has risen in all markets over the last 4 years. And amid relatively strong deliveries and weak net absorption of new floor space, occupiers have moved out and they've simply outpaced leasing activity. Well, that's all true. The agency world is by no means downhearted. That's because the top end of the market appears to be doing okay. Yes, the future of a lot of lower grade office floor space leaves them chin rubbing. Much of it will have to leave the market forever, which means alternative uses or demolition. But overall, they're chipper. Some Manchester occupiers who've been in the market for literally years, like Auto Trader and Bank of New York Mellon, appear to be on the brink of landing. And we're looking at deals here of 130,000 square feet for Auto Trader, 200,000 for the Bank of New York Mellon. This is big stuff. Others, like IT business Arm, are expected to increase their floor space, roughly doubling it to 60,000 square feet, or so the story goes. Looking at the numbers from this kind of take-up point of view, rather than the vacancy angle, makes everything look a lot better. The first half of 2024 in Manchester saw take-up 32% higher than the same period last year. And there's rather more than 500,000 square feet of deals about to land. No wonder people feel chipper. There's only 376,000 square feet of new Grade A floor space available. The annual take-up is about 500,000. You can do the maths yourself, and you can see why they're so excitable. Vacancy levels in Grade A space are relatively low. The expectation is this available floor space will get eaten up quite quickly. Hence, lots of interest in creating good refurbished floor space at places like 1 Hardman Boulevard, Sunlight House, 35 Fountain Street, and so on. This is no time for landlords to dither, I've been told. However, landlords are likely to dither. For instance, there's a widespread suspicion that Landsac Land Securities is soft peddling at the 2.5 million square foot Mayfield development near Piccadilly Station. Lots of leaps of faith are required, I was told about Mayfield. Meanwhile, some of the relatively big refurbishment opportunities are maybe too big. The Rylands building, Manchester's former Debenhams, the former Kendall's department store on Deansgate, even that Royal Bank of Scotland office at Hardman Boulevard, they're all monsters, with refurbishments costing upwards of £250 a square foot, and it can be a long way upwards of £250 a square foot. A 350,000 square foot building adds up to a fortune. You can do the maths yourself, 80, 90, £100 million. With construction costs high and money expensive, interest rates are still astronomical by recent standards, that's not something any landlord wants to consider lightly. Splitting the huge cost into phases is the obvious answer, but even here it's tricky. How do you split a very big building into phases? It's not at all clear. Some clever footwork is going to be required to get these schemes moving. Now in Leeds it's a little bit different. Second quarter office take-up was disappointing at just shy of 100,000 square feet. That's less than half of what was recorded in the first quarter, which was close to 250,000 square feet. City centre office take-up in the first half of this year totalled 348,000 square feet, down a bit, 15% on 2023. a lack of new stock for office occupiers to rent has been blamed. So why don't they build? On this widely shared view, the problem in northern office markets isn't high vacancy rates. Oh no, it's slender development pipelines. Eyes are turned enviously to the residential property sector, where the Greater Manchester Combined Authorities Housing Investment Loans Fund has been priming the pump for years to the tune of several £100 million. Perhaps they could do some of that for the office market, I've been told. Perhaps they could. The alternative view is that the property market is looking at the wrong numbers. Instead of focusing on take-up figures, which are in any case a bit unclear, they need to look at net absorption. So net absorption, that's the amount of letting of new office space you do, less the amount of office space that gets handed back. The result would be a useful change of perspective, I've been told. The spokesman for this case is Les Lang at Till Asset Management, who has some really enormous buildings under his wing. Salford Exchange Quay is one of them. He says it's like being at a party and everyone knows something about one of the guests and nobody is saying. The big agents don't like to talk about net absorption, he says, and it's very frustrating. Well, he's absolutely right. People in the UK don't much like to talk about net absorption, although it's used a great deal more in the United States and to a certain extent in London. Les Lang's argument is that even the existing take-up figures might not be telling the whole story, because a lot of the take-up isn't really take-up, it's just management agreements. The space hasn't been let. He says we're flying blind, or worse, we're guessing, because the data we have isn't very useful. So if we looked at net absorption figures, would they be very interesting? CoStar did some number crunching for this podcast, and the result is surprisingly dull. Manchester's net absorption from 2015 to 2019 was plus 204,000 square feet. That's not really a great deal in 4 years. And from 2019 to today was plus 6,300 square feet, which is really almost nothing. That's a move from a fairly balanced market to a very balanced market. Leeds had a rockier time. It was up by 137,000 in the first of those two periods and then down by 28. But neither are very big numbers. Sheffield, Leeds, Newcastle tell a very similar story. Now, every city except Manchester saw a net return of floor space to the market since 2019, but it was all fairly small beer. Now, please note, you can calculate net absorption in different ways, and potentially other methods would produce less tranquil results. But it doesn't look like there's much to see here, at least not at the moment. So do the northern cities need to worry about vacancy rates or not? Vacancy rates are still going up. You might expect that growth in net demand in Manchester, Leeds and Sheffield, combined with a relative lack of new supply, would push the vacancy rate down. But it hasn't. Clearly something is falling between the cracks, or the data is wonky, or both. The go-to solution for most observers is to say that this is because the Grade A market, the flashy new office space, is now operating autonomously, and so that all market upsumming data isn't very useful. It may be that real-time testing of this theory is needed before we know whether rising vacancy rates are a cause for concern or a cause for yawns. And now your regular rundown of what's going up and what's heading the other way in the Place North elevator. Doors closing, going down. Are you getting excited by the Trump-Harris fight for the US presidency? Maybe you should be getting excited because it could have a real impact on northern property markets. And here's why. US investment in UK commercial property is at a 10-year high, the latest data shows. Not only are the cousins spending more, they are selling less, which means the net stock of US money in UK real estate is going up. CBRE, who keep a track on these things, said US net investment in the last 2 years is up £8 billion. North American money bags splurged a further $2.6 billion in the first quarter of this year, says CBRE. Analysis from BNP Paribas Real Estate put it a little higher, $3 billion, up from $1.9 billion in the first quarter of 2023. But you get the picture. It's likely Q2, the second quarter of this year, will turn out to have been even better. And we know from the US side that a lot of money is heading this way. Between 5 and 7 billion pounds is likely to land in UK real estate throughout 2024. It could be a lot higher, maybe 10 or 11. That's a substantial increase on the previous year. And those figures come via money market translations from Knight Frank. The context is that plenty of that money is heading north. New York-based KKR is behind the Manchester St Michael's development, and Dallas-based Trammell Crow Company is expanding into the Manchester office market via its subsidiaries. In Leeds, New York-based Citi Private Bank paid $38.5 million for the block at 1 Sovereign Street, and there are more rumours of American deals to come. The explanation for all this activity lies in dollar-sterling exchange rates and the strong dollar that makes buying in the UK look appealing. The spiralling crisis in the US office market adds to the appeal of transforming the basis of many funds from US central business districts to relatively safe office streets of London, Manchester and Leeds. So what happens if US policymakers decide a strong dollar isn't such a good idea? Then the relative appeal of investing in UK commercial property falls substantially. Now, Donald Trump, the Donald, has repeatedly said a strong dollar hurts the US economy, and if he wins, he will try to devalue. The last attempt to devalue the dollar in a really concerted, deliberate way was in 1985, and it didn't go spectacularly well. So there's no guarantee of success. But if the Donald gets his way, watch out. Angela Rayner's planning shake-up will include tweaks to make it easier for data centres to win planning consent. The subsector is already a nice little earner for some northern landowners. In the last quarter, Microsoft agreed a £106 million land deal with Haworth for 48 acres at Leeds Skelton Grange, and Blackstone eyed up a similar-sized deal, £110 million, at a site in Northumberland. A surge in data-hungry AI technology and a seriously undersupplied London market are together driving demand northwards. CBRE's half-year estimate was that availability, which is measured in power rather than square feet, had sunk to a 6-year low of 119 megawatts. That's low. Land and power is more readily available out of the southeast. It's also a little bit cheaper. Now, Rayner's direction of travel became apparent a fortnight ago when she called in 2 large Greenbelt data centre applications for sites in London's leafy hinterland. Both had been rejected until she intervened. Rayner's Tuesday statement in the House of Commons included the line, "Alongside building the housing that we need, the government is committed to making it easier to build key infrastructure such as laboratories, gigafactories and data centres." It's not yet clear what that means at the time of speaking. Nothing has appeared on the government website which gives us much help in understanding what size thresholds will be involved here, what sites, what locations and on what terms. But for plenty of risk-averse northern landowners, looking at the huge costs of building a big shed and a dip in big shed leasing activity, this could be a seriously interesting alternative. So that's it for today. We've wondered if the office market is right to be relaxed about vacancy rates, or are they just pretty vacant? We've got excited about Trump versus Harris in the US presidential race, and we've readied ourselves for action on data centre planning. For more about the built environment in the north, visit placenorth.co.uk. I'm David Thame, and thank you for listening.